Balchunus joins us once more. He is a senior ETF analyst at Bloomberg Intelligence. We'll be talking about recent trends in the ETF space.
The big race and the one that's it's a lot of unknowns, but I think it's promising is private assets. So private credit and private equity, whether people can get you exposure to this. I could see them doing this, and I think this would be inventive. You buy ETFs that lean towards capital expenditure companies.
What these trends may signal in terms of investment appetite and what the Fed cut may do for certain sectors.
I do think the Fed probably will overwhelm the election.
Welcome back to the show, Eric. Good to see you.
Good to see you.
We'll also be getting your outlook, but just analysis on current Bitcoin ETF trends. But first, let's talk about what you told me offline just now. Let's start with this, Fed cuts and what this means for markets. Historically, when the Fed has pivoted in the past, which types of ETFs have done very well?
Yeah, so we continue to see flows into like S&P 500, NASDAQ 100, the total market. We'll call those like vanilla beta. Those funds rake in money, rain or shine. But obviously when the Fed cuts, and that's generally good for all equities. So we see nothing slowing down that sort of ongoing train. But on the outer layers, there's definitely some shakeup. Like, for example, right before the Fed cut, there was a lot of people who piled into value ETFs. But since they cut, that you've seen high growth do a little better. And we wrote a note recently about ARK, which was sort of a famous innovation fund run by Cathie Wood. It's her flagship fund. Had this huge, incredible rise when there was zero rates during the Fed zero rate era, COVID. And then it came crashing down to earth when the Fed raised rates to fight inflation. So if you graph rates and ARK, it's inversely correlated. Well, now that rates are coming down, ARK's starting to perk up again. And we're wondering, we just study how products work and what gets flows and what doesn't. And an interesting question or something to watch is, can ARK get a second bite at the apple? If it comes back and starts doing well, will investors come back in? The good news is it still has $5 billion, which is a decent amount for an active equity fund. And it's had 3 straight weeks up. So it's not alone, though. There's a bunch of like tech type thematic ETFs that are also in the same boat. Most issuers now have a quote innovation strategy. So when we think about the Fed cutting, it's going to probably mean good news for high growth stocks, tech stocks, some of these themes that are tracking companies that might not make a profit just yet. This is all opposite of the past 3 years where everybody wanted companies that had a ton of cash on hand. So we'll see if that changes. It's only been one cut. We'll see if there's more cuts that follow, but that's something to watch. So on the outer layers, you could see some shakeup, but the core, this is just like a blob of money that just keeps buying like the big indexes.
So basically, you're expecting to see outperformance in high cyclical tech industries and ETFs?
Yeah. I mean, again, the Fed cutting is really, the market loves that, both bonds and stocks like that. So there is the election, that's a variable. So I do think the Fed probably will overwhelm the election. But we'll see. We've got like 2 months left in that. And so if there's some volatility there or uncertainty, that might derail everything. But this seems like inflation is sort of like, been tampered down, Fed cuts, and yet the economy is showing pretty good numbers. It's a pretty good scene for investors.
If you take a look at, let's just take a look at ARK since you brought that up. So this is the ARK Innovation ETF. Done tremendously well 2020 and then came crashing down to earth 2022 during a Fed hiking cycle like you talked about. However, if you just take a look at what happened with the NASDAQ, outperformance by the NASDAQ compared to ARK during the same period. Is a Fed rate cut, though, enough to make an ETF like this catch up?
This is a great point. So I agree. And this is a tough chart for Cathie and ARK, but you got to remember the NASDAQ isn't the same index it was 20 years ago. The companies in there, NVIDIA, Apple, Microsoft, have a ton of cash on hand. So while they are like techie companies, they're also just cash giants. ARK stocks tend to be very low on cash. They need the debt markets, right? So if rates are higher, it's going to be a higher cost of capital to them. Whereas if you have a lot of cash on hand, higher rates aren't going to bother you as much. So her stocks tend to be much more high growthy. So that's why I'm saying is that it's possible, again, I'm not saying it's going to happen, but if there was like another 50 basis point cut, or an aggressive series of cuts, you could see those sort of more non-profitable reliance on the debt market stocks do better. The Qs is really a fascinating index because it does have that sort of tech growth theme, but they also have the cash. So the Qs is just, we always joke on the team about how the Qs just always kind of destroys everything. I mean, it's just like any market, it's just going to like run you over, whether, small caps have a month, international has a month, value has a month, but then it just, boom, the Qs are right back. So the Qs is definitely a special index, and a lot of money goes there. It's rewarded for that performance. But again, ARK and the Qs are definitely kind of playing two different games, in my opinion.
Before we continue with the interview, I'm going to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. Let's move on to broader themes in the ETF industry. You tweeted not too long ago, milestone ETFs have officially passed $10 trillion in assets in the U.S. Normally, they double assets every 5 years, but this time it only took 3.7 years. They now also have double index MF funds assets from which we predicted they would hit $25 trillion in the next 10 years. Mm-hmm. Why are we seeing a exponential growth rate into the ETF industry here?
Yeah. So first of all, everybody's just sort of getting the message that you can get the entire market, almost a whole portfolio for almost no fee. That's going to bring people, it's going to create demand. And so you've got that general demand for the S&P 500 or total market. Everybody likes this sort of cheap exposure to bulk beta, but at the same time, you have this massive amount of companies coming in like Capital Group, Morgan Stanley, that are more on the active side, creating products that do covered call strategies, that do targeted outcomes like structured products, and then traditional active, but for a lower fee. So the innovation and pressure to compete in the ETF world has actually created innovation and lower fee versions of active. So you've got the passive sort of blob that does its thing, but on top of that, you're having more of active come in and do its thing, but in a way that's more value add than it did in the mutual fund area. So really, we call that like sort of the other guys, because like Vanguard, BlackRock, and State Street have dominated the ETF world, but the ETFs that are not those three are now taking in about half the money, and that's major. And that is some of those companies putting those other products out. So the product innovation is a big part of why we are bullish, because the more people who come in here innovate both on structure, strategies, and fees, the more you're going to find people who are coming in for those products. But that's all on top of that general 60-40 flow, the regular average advisor out there who has their clients in the 60-40 portfolio. They love the fact that you can get all the stocks and all the bonds for like 4 basis points. I'd argue that's the majority of the flows. But that's been that way for a while. So we tend not to cover it as much, but that's still the bulk of the flows. But this other sort of new innovative area with active is helping to add tailwind to that number. And we've looked at things that have come out to try to compete with ETFs, like direct indexing and tokenization. None of it is as cheap and easy and liquid and frictionless. And so we don't think it's really a competitor now. I've not seen anything that can really do any damage to ETFs. Maybe at the fringes, like a direct indexing account is like maybe applicable to a really high net worth individual who has some tax just aversion and really can maybe use a direct indexing account to like deal with some taxes. But besides some niche cases, we just think the ETF is sort of the investment vehicle for the next 10 years at least. And by the way, the other thing that people underrate is we can get the whole market for almost no cost at the click of a button, so there's no friction. it's also got this huge regulatory and structural backing. There's lawyers, there's an administrator. The SEC has approved it under the 1940 Act, which is the strictest of acts for funds. So you've got this sort of infrastructure and anti-fragility backing it, while it's very cheap and frictionless. So that's kind of the best of both worlds. It's just really tough to compete with that amount of value proposition.
Can we see a scenario in which more of the market's float is absorbed into ETFs and funds, and thus perhaps the liquidity profile of the markets overall would change?
A little. So ETFs and funds, so mutual funds and ETFs collectively own about 40% of all the stocks. They own about half that of the bonds. Bonds are way bigger market, but let's just stick with stocks. 40% still minority, but let's say ETFs took over all that. Okay, fine. ETFs own 40% because mutual funds have been phased out. In that 40%, though, is a lot of active, a lot of smart beta, and then some passive. And so ultimately, the smart beta is going to invest based on fundamentals, and so is active. So there's still going to be a rewarding of certain metrics that stocks put off. You have a high dividend, there's definitely some ETFs to buy you. You have a low valuation, some value stocks, but ETFs will buy you, or active will buy you. But certainly the passive component, that's sort of buying robotically into whatever is just a large company. What we think is that the ETF investors are pretty well behaved. So in sell-offs, they tend not to pull money out. So what I think you're getting at is the float of a stock. Let's say the float was 70% of the shares out. Let's say ETFs eat up 25% more. And that money is basically solid and never moves because it's like Then you've got a smaller float that trades, which means you could have more volatility. This will probably affect smaller names more. That's why I think GameStop was able to be like hijacked. But bigger names like Apple, they're almost too big to do that with. But small names, you could see some funky stuff with ones that have just a small sliver of their float traded, for sure. But honestly, that kind of volatility might help active make a case for itself as we move forward. But sure, but at the end of the day, even if ETFs or passive go 100% of what they can get, they're still only 40% owners of stocks.
Okay, and how do companies feel about this trend? Do they like the fact that money is going into ETFs and not their stock directly?
So asset managers don't love it. I mean, I always say that this market is heaven for investors, but hell for issuers. But this is what the investors want. Like there's certainly a lot of retail stores that aren't thrilled with Amazon. It hurts painful, but the people, Amazon is so easy and cheap that you're going to find customers. So same deal. Every industry goes through this. Taxi cab drivers do not like Uber. And this is what this industry is going through. The companies themselves that are owned by some passive, I don't think they care that much. I think they're looking to make payroll. They still have a ton of active owners who are complaining about this and that and the other. And then the passive people who own them, like a Vanguard or BlackRock, if the company has something to vote on, they have a corporate governance team that votes on that stuff, and they'll vote how they feel it's right. So in a way, they're almost like another active owner. So I don't think corporate America cares that much. I think more inside the industry, though, by all means, this is a very scary and painful transition. But it's not the only industry that's had to go through something like this.
Well, okay, so $25 trillion in, I guess, assets in ETFs is what you're projecting over the next 10 years. What does this mean then for the active fund management industry? How do fees change? How do structures change? How do strategies change?
Yeah, I think what you're going to see is a barbelling. So if you're active, take I won't pick on Fidelity, but I will. Okay, take a traditional Fidelity fund from the 80s or 90s. You're going to open it up and you're going to see Amazon, Microsoft, and it's going to have like maybe 30% difference in the S&P, small bets. Well, that, if you charge like 90 basis points for that, that's probably an endangered species. So what active is doing, it's either going to get cheap. So if you have if you look a lot like the S&P and you have a lot of sort of quote beta in your portfolio, you better adjust your fees to the account for the fact that beta is now free. So you only charge for the active, which means that if you have a lot of beta in your fund, you have to lower your fee. If you have a lot of active share and are very different than the benchmark, you can charge more. So we just think that if I wanted to put it into real simple terms, active kind of has to get cheap or shiny. They can't go the middle route because if you're active and you look up the fund and you see the holdings like any investor and you see Apple and Microsoft and Google in there, you're going to go, I don't know if I want to pay 90 bips for this. I can get that for 3 because it looks just like the S&P. So you're going to have to differentiate if you want to charge more or lower your fee, which is what DFA and Avantis have done successfully. They are very, very much have a lot of beta in their portfolio, but they also charge between like 10 and 20 basis points. So the metaphor we use is a bag of potato chips. Just charge people for the chips, not the air. And I think for years, people charge people for the chips in the air. So you have to now adjust your fees to account for the fact that nobody wants to pay for the air, which is beta. Makes sense? Because you can get beta now, which in a Vanguard index fund for nothing.
Okay, well, let's do the reverse exercise. Is there any new strategy that hasn't really been fully saturated within the ETF market that you see could flourish over the next couple of years?
Yeah, the big race and the one that's it's a lot of unknowns, but I think it's promising is private assets. So private credit and private equity, whether people can get you exposure to this, because right now that's only for institutions. Like you need to be a big asset owning institution to get access to privates. But the ETF issuers are very creative and they're going to work for ways to bridge that gap and to give regular investors access to private markets. There was a filing recently with State Street and Apollo for a private credit ETF. And how do you make something that's illiquid liquid is part of the puzzle. And the way they decided to solve that is that Apollo, which is a dealer of private credit, is going to provide the liquidity backstop for that part of the portfolio. So this is very interesting and one possible way to sort of get closer to bridging the gap between private and ETFs. They've tried putting private assets into things like interval funds and even mutual funds to a degree. But the problem is nobody wants it that way. So, let's use music. ETFs are kind of like digital music. Like if you have a great, song or whatever, you don't want to put in an 8-track cassette tape. No one's going to buy it.
Sure.
But you put it on Spotify, you have a chance. So we think that there's just so much pressure to deliver anything and everything into the ETF format that they're going to try to even like almost put a square peg in a round hole, which is to say take privates that are illiquid and put them into an ETF wrapper. And I think they'll succeed to a degree. And there's 13 trillion in private asset funds. So that is a monster. I mean, that's bigger than ETFs in the US. So if some of that can be sort of worked into the ETF, you could see it's almost like a whole planet that hasn't been explored yet by this sort of very innovative and very creative ETF industry. So look out for that.
2 trends I want to highlight before we go. You tweeted the Chinese government, aka the national team, is on an ETF buying spree, BOJ style, to jumpstart stock market. They've already plowed $91 billion into ETFs, headed towards $110 billion, which is 80% of the flows over there. Why are they doing this? What's going to be the effect?
Yeah. So remember in way back when the Fed bought stocks, or injected liquidity into the market. This is like QE, So basically in China, the stock market is so bad, and it's been so bad for so long, that the government wants to try to juice it up. And Japan had the same problem. So the Bank of Japan bought a ton of ETFs, and it worked to a degree. And so the Chinese government is doing the same thing. So they're now buying like 80% of the flows into China ETFs are the government. But it's kind of working. Like the Chinese stock market's up 20% in the last month. So that's a ton of money for that ETF market. And it's not the first time somebody's done this. I mean, even the Fed bought bond ETFs in COVID. So when a government wants to sort of like get the markets going, the ETF makes it easy because you just buy one ticker, but the money floods down into all the stocks. So ETFs are kind of like a central bank tool now to be able to get in and out of markets, prop them up when they need to. So it's not a huge surprise. What's interesting though is that local Chinese investors, just until like the last month, they weren't biting. They wanted to go and get the Qs. And so they were buying these ETFs that sent their money overseas. And the Chinese government did not like that. So they poured more money to the market, and they gave many people have limits to how much they could buy the NASDAQ 100 through ETFs there. So ultimately, it's kind of working. They put so much money in that it's now up 20%. So what they're hoping is the locals there stop trying to buy America and come back to buy local Chinese stocks. And that's what the Chinese government's grappling with in the ETF, sort of the vehicle they're doing to try to sort of, it's almost like resuscitating the stock market with a defibrillator.
Could you see a scenario in which the Federal Reserve here in the U.S. Does something similar when stock markets are crashing? Let's say there's a financial crisis. Instead of buying up treasuries and pumping up the assets on the balance sheet through treasury sales, they actually directly buy stock market ETFs?
Yes. So in COVID, they bought a bunch of bond ETFs to give liquidity to the bond market, and just to tell everybody that, hey, we're here buying bond ETFs, which ultimately trickles down to the bonds. I think ultimately we could be in a crisis. Let's say we're in a really bad crisis and stocks and bonds are down, whatever. I could see them doing this, and I think this would be inventive. You buy ETFs that lean towards capital expenditure companies. The Bank of Japan started to do this. They were buying the regular index, but then they were like, wait, a lot of these companies are just using our money to do buybacks. So they started to shift the money towards indexes that favored R&D and capital expenditures, which would help jumpstart the real economy. So I think they may actually start to work with BlackRock to design ETFs that are like really the closest they can be to the companies that will spend money on people and capital, which would help to, again, jumpstart not just the stock market, but the economy. So I could see them getting creative with how they do this as we go into different crises. So certainly if they bought bond ETFs, they could do that again. And I do think they could evolve into buying stock ETFs, especially if the stock ETF had an extra component that rewarded companies that did CapEx.
There wouldn't be any conflict of interest there if they're directly buying companies they like?
Well, they would say we're only looking at CapEx, or they would say, in terms of the, say take the bond market when they bought the bond ETFs. Some of the bonds were from different companies, but they were pretty fair. They said BlackRock has 50% of the bond ETF assets, so we'll do 50% BlackRocks, 30% Vanguards, and we'll mix up some other ones. And they bought some Fallen Angels, they bought some IG. I think they had one high yield. They were pretty cool about being pretty fair, I thought. I think they'll do the same, but I think if they made the case to themselves and the American people that we're actually going to favor companies that do CapEx, because one of the complaints about QE was that companies were using the low rates and the money to just buy back shares. And all that does is reward shareholders, and not everybody owns stock. So that leaves a lot of regular people out of that whole system. So CapEx would be one way to help make that money trickle down further.
Interesting. Finally, let's talk about Bitcoin ETFs. I want to just show this chart real quick on my screen here. If you just take a look at my screen, Bitcoin price versus ETF flows. The yellow line is the price, and cumulative flows is the blue. It doesn't look like they've been correlated, at least not as of mid-June. Why the divergence here?
Yeah, well, first of all, there's been a couple dumps. Like I think Mt. Gox had to settle some stuff. They dumped. Germany dumped. And then you've got, I think, some of the people who were, quote, the hodlers. Once it hits 60, 65, they tend to sell. And then I think there's really a lot of selling that happens around 69, 70, which is why it hasn't broken through a new high. Remember, a lot of these people who invested in Bitcoin early are now older. They probably have more responsibilities. So I could see some of them taking some profits, but it's hard to deny, the ETF flows are, as we put them, 2 steps forward, 1 step back. So they'll go on this nice little run for a month or two, but then they'll have like 3 weeks where they kind of take a step back and there's some outflows, but they're net buyers. I mean, we're at 18.8 billion in net year-to-date flows. That's the most important number because that is net the GBTC unlock, and it's net any like outflows that happen during one of these step backs. So 18.8 billion net is a ridiculously high number. And in general, I have to battle with these, hardcore crypto types because I'm trying to tell them like, look, the ETF hype brought you from 30,000 to 45. Then when the ETFs launched, the flows brought you back up to 60. And there's been a bunch of dumps and you remained around 60. I would take that. I would thank the ETF because I personally think you'd be down at 30 still between all the dumps and no ETF approved. Let's say the SEC just was going to just deny them into oblivion. I just think you're half the price you are now. So I would take 60, 65 as a huge win at this stage. Now, going forward, you've got BlackRock, Fidelity, and some other massive companies, Invesco, armies of wholesalers. These ETFs are going to start making their ways into models. They're going to be making their ways into advisors. It's a pretty good bullish story, and I wouldn't sweat this too much if I was them. But certainly, you can see that the flows plateaued a bit from that nice run up. But as I told them, if you look at the past 5 years, Bitcoin returns 50% annualized, right? You're already up 50% this year. So if you did nothing, you should be happy. But they're never happy. They aren't.
You want another 50% more. What's going to take us to another 50% more? Is it more Bitcoin ETF flows?
No. I sometimes ask them, like, what do you want? Like, what would make you happy? And it's like, they want I'm a 60-40 person. If I get 9-10% a year, I'm thrilled. That's how high their expectations are. They're just, I think it's sort of like a drug. They had that rush of like a couple God candles here and there, or a year when it went up like 400%. And it's really hard to replicate that high. So they end up kind of miserable unless they can go back to that. And I'm like, you better adjust.
That was a very difficult philosophical question you asked. Like, at what point? Like, it's like somebody. I was at church a long time ago. Somebody asked me, "At what salary would you be happy?" Well, I don't know. I mean, once I make 100K, I'm gonna want 500K. I don't know. Like,
totally. Yeah, there's a lot going on to unpack with that sort of. Again, this is what I tap into, and the only reason I'm debating them is because I'm trying to explain that they have this theory that BlackRock and Coinbase has replaced the actual Bitcoin with IOUs.
Yeah.
And that would be illegal. BlackRock also, they have 500 ETFs. They do it all the same way. They don't want to be short the ETF anyway. So they're just so frustrated the price hasn't gone up more. But again, they're already at what you're supposed to get annually, 50%, which again is 10 times or 5 times that what a normal investor expects.
One of the fears of the Bitcoin ETF launch is that it does give institutional investors more avenues to short Bitcoin. Is that what's happening right now? Is that why the price is kind of been trending down?
It could be. I don't know if we have short interest data on IBIT. That's a good question, but yeah, maybe a little bit. Plus, there's now inverse Bitcoin ETFs where you just buy it and you're short. But looks like the short interest is moderate. Honestly, would you short? I would never short this. I mean, you could get burned. I would.
Yeah,
I would almost use options, although they're not ready yet. Although we think Q1 we'll see options on these ETFs. But I personally think you got to remember the ETFs own 4% of the outstanding. So there's many other players here moving and doing things, and including a lot of retail investors who might have bought this like 15 years ago, and now they're being told by their significant other, "Hey, look, you gotta sell some of this, put it in the 401k or buy a house." So I could see a general, selling pressure from like people who need some money, like that you can use in the real world.
Bottom line, Eric, are you seeing any trends in ETF inflows for Bitcoin or outflows for that matter that may signal change in sentiment right now?
Not really. Because again, I said it early and I feel like I nailed it. 2 steps forward, 1 step back. So, I think that's going to net you 1 step forward over time. But here, they're all liquid. They're all very cheap. And most of them are big brand names. So you've got all of the boxes checked that an advisor would need to buy an ETF. Now it just comes down to can the wholesaler sell them on the concept of having this as a portfolio allocation? And many of them are going to be able to do that. So I think that wave is slow moving, but very positive. Along the way, you're going to see these like 20% downturns where some people puke up a little bit. But so far, the percentage of people or the percent of assets that have hung tough has been like 95, 96. So like only like 3-4% of the flows are coming out that are a percentage of assets. So for the most part, this is a very, very strong hands here. And I'm not surprised because I think anybody buying this from that uses an ETF is not going all in. This is like a 1% allocation, and they're just like setting it and forgetting it for 10 years just so they don't wake up in, year 2030 and it's $1 million and they're like, oh, damn it. So I don't think these are just not the kind of people who are going to be like trading this that much, I don't think. So, and it's proven to be true.
Excellent market update. Thank you very much. Eric, where can we follow you?
Well, you can use my X handle at Eric Balchunas, or I have a podcast called Trillions, which you can find anywhere you find podcasts. So I do ETF podcast. Those are two good free of charge places to get me. That's good enough.
All right. Yeah. And then if you have a Bloomberg terminal, I guess we can read you there as well.
Yeah. I mean, if you have terminal BI ETF Go.
Okay. Excellent. Thanks very much, Eric. Speak next time.
You got it. Thank you.
Thank you for watching. Don't forget to like and subscribe.